This is Matt Godleski with Cap Trust Advisors, formerly Stewardship Financial Advisors, bringing you this week's snapshot edition of The Pulse. Here's our watching this week. Equity markets drift lower, while Treasury yields hold steady, and inflation concerns are heating up. Stocks retreated this week despite strong earnings reports and job numbers that continue to surprise to the upside. Claims data for the unemployed came in lower than expected, and worker productivity increased at the fastest pace since 2009. For earnings last quarter, S&P 500 companies have beaten projections by an average of 22%. The mismatch of supply and demand created by the shutdown last year and skyrocketing economic growth continues to worry investors, with fears of an inflation spike ahead. Treasury yields have remained in a tight range. Former Federal Reserve Chair and now Secretary of Treasury Janet Yellen suggested this week that yields will need to rise from current levels given the strength of the economy. These comments rattled investors who fear that higher rates and inflation could put a damper on growth and lead to a withdrawal of stimulus. In fact, quarterly earnings reports suggest inflation is already here and helping corporate profits by expanding margins. Zero interest rates in the massive bond buying program of the Federal Reserve have some officials warning of speculative excess, and with good reason. Financial conditions are the easiest on record, dating back to the early 80s. Chairman Powell himself called markets frothy, but argued that the strong economy was to blame and not monetary policy. Avoiding an asset price implosion like 2001 or 2007 is of paramount importance to the Fed for this cycle. Their goal is to communicate with markets about their intentions well in advance to avoid any sharp downturn. Dividend increases and big flows into equity funds should provide comfort to stock investors. In April 2021, 33 companies increased their dividends while none saw decreases or suspensions. This is the total opposite of last year, when more than 24 firms reduced or suspended their cash payout to investors. This speaks to the strength of corporate cash flow currently. Investors have also poured more than $250 billion into equity ETFs this year alone, as exuberance over the recovery remains high. We maintain a balanced approach of staying invested because we believe the recovery is stronger than forecasted and will continue to surprise to the upside. Additionally, we need to earn some return at least to stay ahead of inflation. Per the Federal Reserve, asset prices look high and caution prevails in adding to risk at present. We continue to remain focused on monitoring unfolding market dynamics and reacting only when appropriate. Thanks for watching, and check out our website to read the full edition of The Pulse for more details.